Hello, and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you joined us for the second day of our Metals and Mining Conference. Our next live presentation is from Anfield Energy. Anfield is a uranium and vanadium development and near-term production company. Please note you may submit questions for the presenter in the box to the left of the slides. And you can also view a company's availability for one-on-one meetings by clicking Book Meeting in the top toolbar. At this point, I'm very pleased to welcome Corey Diaz. He's the President and Chief Executive Officer of Anfield Energy, which trades on the OTCQB venture market under the symbol ANLDF and on the TSXV under the symbol AEC. Welcome back, Corey.
Thanks, John. Appreciate you having me on. And thanks, everyone, for joining us today. As John mentioned, I'm the CEO of Anfield Energy. We're a U.S. developer and near-term producer story, and our aim is to move into production of uranium and vanadium in the United States in the next 2 years. So we'll walk through our plans in that regard. The safe harbor, please feel free to read at your leisure. The capital's market profile, as John mentioned, we trade on the TSX Venture under the symbol AEC. We trade on the QB under the symbol ANLDF. We have a market cap of roughly $100 million. Our largest shareholders are Uranium Energy Corporation, which holds about 18% of our shares, Encore Energy Corporation, another uranium producer, about 15%, and then management insiders hold about 4% of our shares. We have analyst coverage for the story out of Red Cloud Securities in Toronto with a target price of 20 cents a share. On the slide to the bottom right, you can see a picture of our mill with the hills in the background. So in terms of reasons to invest in Anfield, why Anfield? We've got an advanced suite of assets. There are a few others with the capacity to get into production in the near term. So that's one of our advantages, value propositions. We've got a geographic advantage. The U.S. market is the place where we should be and where parties should be if you're in the uranium space. The United States has the largest installed base of reactors worldwide, and yet produces very few pounds to feed those reactors. So there's very little domestic supply, which provides us with an opportunity to become a significant producer and supplier of pounds to those reactors. Our peer valuation, most of our peers who have production capabilities trade at multiples somewhere between 5 times and 40 times our current market cap. So we think there's an opportunity for us to close that gap going forward. And finally, just within the U.S. itself, the U.S. government has a Buy American policy. There's been talk of tariffs being placed on pounds coming in from foreign suppliers. We've been loosening of regulations, strategic mineral designation for both uranium and vanadium. There's a pro-nuclear Secretary of Energy that's just been installed in the U.S. government. And then the Department of Energy and Department of Defense both provide funds for the facilitation of nuclear-related activities, which also includes production of uranium. So in terms of catalysts for Anfield itself, our plan is to get onto the NASDAQ in the first half of 2025, which obviously will open doors to U.S. institutional and retail investors. We're working on Shooting Canyon mill permitting. We did submit the application last April. We did get a letter from the government saying that it's all in compliance in terms of completeness of the application. The aim here is to move our current status from standby to operational. We're also looking to increase the throughput capacity at the mill from 750 tons per day to 1,000 tons per day. And then finally increase the licensed production capacity from 1 million pounds per year to 3 million pounds per year. In conjunction with that, we're looking to upgrade our 2023 PEA, which included the Velvetwood mine, the Slick Rock mine, and now we'll look to include some of our West Slope properties, the DOE leases that we hold in Colorado. The West Slope properties incorporate or include 9 of the 21 DOE leases we hold in Colorado. So we do have a resource report for 4 of the 9 mines related to the West Slope, and we'll look to add economics to those mines while we advance those ones, plus look at the other DOE leases for prospective plans to advance those too. And the updated PEA will also include the increased capacity that I've mentioned that we're seeking through the state of Utah related to the Shearing Canyon Mill. On the mill side, we're also looking to do some work at the mill, pre-construction work, as we go through the licensing upgrade process. That includes, demolition at site and some cleanup, installation of new power generators, and electrical upgrades. So we'll be in a better position once the license has been approved. We'll be able to accelerate our plans to refurbish the mill. And then finally, mine advancement. So we do have both the Velvetwood and Slick Rock mines, which would be part of the first feed into the mill. The Velvetwood mine, we're expecting to see the plan of operations for that in the next few months, after which we'll be applying for a large mine permit for the property. And in Slick Rock, we just completed a drill program the end of last year, which confirmed the resource that we have in place. It'll allow us to move some of the inferred resource into indicated resource and potentially expand the size of the resource. But all these things show that we're moving to advance the assets towards production by 2027. In terms of the macro overview in the uranium space, I'm sure many of you have been following the news. There are a lot of geopolitical risks associated with the sector. In Russia, Russia's holds the largest enrichment capacity worldwide, and yet they're at loggerheads with the West, so that becomes a challenge for a number of Western-based nuclear reactors when it comes to securing supply. China itself, is heavily involved in the nuclear sector, has been building out reactors at a very quick pace, and Kazakhstan and China have been forging a stronger alliance, which means a lot of the pounds that would usually come from Kazakhstan to the West are now heading east to China. We look at the military coup in Niger last year, which slowed and stopped production coming out of Orano's mine in Niger. And then the U.S., as I mentioned, largest installed base of reactors, but yet no real domestic supply to talk of. Opportunities remain in terms of the build out of nuclear. China, UAE, Eastern Europe, reactors being improved. Japan has started to turn on a lot of the reactors that had shuttered as a result of Fukushima. The U.S. Has a 200 gigawatt roadmap in place, aiming to expand mining and milling of uranium production, just given the geopolitical risks that we mentioned earlier. And then obviously AI is a new entrant into the market. The fact that those things, AI is going to require a great deal of power. There was an agreement signed by Microsoft and Constellation late last year to talk about collaborating on providing that power. So it's another entry into the marketplace for nuclear power requirements. The supply remains an issue. Cameco has seen some weakness in its production as a result of its partnership in Kazakhstan with the Inkai mine. Physical uranium funds continue to buy pounds of the spot market, and Kazatomprom production, as a result of the lack of acid, has seen production misses and expects lower production this year. But yet still the pounds that are being produced are actually going east towards China. So when we're looking at demand increasing and supply tightening, the only thing that can happen is the uranium price starts to go up in order to attract more parties to start production. So in terms of our portfolio, you can see in the top right, we have a number of circles. The gray dot represents the Shearing Canyon Mill, which serves as the hub in our hub and spoke strategy. The blue dots represent the spokes or the mines that would be feeding the mill. The dark blue dots at Velvetwood and Slick Rock will serve as first feed and are the two mines which are incorporated into our 2023 PEA. You can see that some of the mines themselves are actually more vanadium mines than they are uranium mines. So the vanadium side of the story actually could be fairly attractive as we go forward as an ancillary business, which can generate significant revenue for the company. Shearing Canyon Mill, as I mentioned, it serves as the hub, one of only 3 licensed, permitted, and constructed conventional mills in the U.S. The other 2 are held by Uranium Energy Corporation, the Sweetwater Mill, a multi-billion-dollar corporation, And then Energy Fuels holds the White Mesa Mill, and Energy Fuels itself is a billion-dollar corporation. So we're in pretty good company in that respect. The conventional mill, it's 750 tons per day throughput. As I mentioned, we're looking to increase that to 1,000 tons per day. And we're also looking to increase the production capacity from 1 million pounds per year to 3 million pounds per year. And you can see some of the inner workings of the mill in the pictures to the right. The spokes that I mentioned and that we saw on the map, Velvet Wood Mine, historic production of 4 million pounds out of Utah, 5 million pounds vanadium. There's an M&I resource at site at the moment, and the 2023 PA showed positive economics related to this asset. Slick Rock in Colorado, once again, we did complete a drill program at site end of last year. Some of the inferred resource that we have at site, 8 million pounds or so of uranium, 47 million pounds of vanadium, will be moved into another category, the indicated category, and has been confirmed as the resource being there, as a result of the drilling that we did do. Positive economics related to this asset is shown and reflected in the PEA, and plans to move that asset forward in 2025. And then finally, another spoke that we mentioned, the West Slope project would consist of 9 different mines. We did put a resource report out on 4 of the 9 mines. The aim is to get economics tied to those other 4 properties and a resource report for the remaining 5 properties. The 4 properties that we did get a resource for, it returned 5.4 million pounds of uranium, about 27 million pounds of vanadium. With the 5 remaining mines, about 4 million pounds of uranium, about 20 million pounds of vanadium. You see the economics related to the PA on the right-hand side of the page. Post-tax NPV about 197 million, pre-tax 238 million, and IRR 33%. So in terms of the greater pipeline, we did pick up an asset in late 2023 called the Marquez Montefiore project in New Mexico from Encore Energy. The value proposition from our position is that it's the largest single uranium resource within our portfolio, about 18 million pounds. It's an advanced asset with historical resource, which is the type of asset that we tend to seek out. It's an entry point into another market in which we didn't have a presence in New Mexico, and can serve as kind of the anchor asset as we move forward towards phase 2 of our production plans. So Anfield steps to production in the near term. Sheetering, Velvet Wood, and Slick Rock are the assets that we'll be using for near-term production. As I mentioned, we are waiting for the license to be approved, the license upgrade to be approved. We do have economics tied to this grouping of assets. As I mentioned, pre-tax $238 million, post-tax $197 million. The addition of the vanadium circuit at the mill will provide us with a number of opportunities to create even more value through increased type of asset, or an asset which can be upgraded and sold for greater value than what we could bring in as a result of just focusing on uranium. Midterm, we're looking at the West Slope properties that I mentioned before, and ideally the first 4 mines associated with West Slope on which we have a resource. We'll be looking to increase those, and potentially include those as part of our 2025 PEA. We'll also be looking at the remaining 12 DOE leases that we hold in Colorado. We have a total of 21, and to see which ones are the most prospective, and look to add economics to those ones, and determine whether or not we can amalgamate some of these resources to create an even greater pool of resource from which we can produce. And then finally, longer term, we'll be looking at additional assets, securing additional assets which are complementary to what we have within the portfolio, and also look within the portfolio itself for which assets we should pursue production with. For example, Marquez Montefiore, Frank M, Finley Tank, and Artillery Peak, Marysville, and Calf Mesa, all assets within Colorado, Utah, Arizona. So, staying within the same boundaries that we'd set previously. Through the peer comparison, I touched on this earlier. These are all companies with either production facilities currently in place, or ones which are very close to having production facilities. As I mentioned, the smallest of these companies has a market cap which is roughly 5 times bigger than our current market cap. and the largest having a market cap of closer to 40 times our existing market cap. So I think that the valuation gap will be narrowed, first of all, as we get to the NASDAQ and get greater exposure to US investors. But secondly, as we move towards production in 2027, we think that we'll see an improved valuation related to the company. Management directors, I'm a co-founder of the company. I've had over 20 years of capital markets experience. My other co-founder, Josh Bleak, he's the fourth generation miner out of Arizona, our man on the ground, who's helped to find and secure some of these assets within the portfolio. He's got extensive resource development experience, former president of American Energy Fields Junior Uranium Company. So someone with a lot of experience, relevant experience within the sector. Doug Beam spent 50 years working in the uranium sector, has his own engineering consultancy, construction operation related experience. So the person, our point person when it comes to advancing the mill towards production. Ken Wyszynski, our chairman, over 30 years of nuclear related experience through General Atomics Corporation out of California, has run Quasar Resources, which is within the portfolio of GA, and that is a uranium producer out of Australia, and sat on the management committee of Converdyn, was the conversion facility in the US. So lots of relevant experience on our board. And then finally, a little bit more on the mines themselves. So Velvet Wood, we acquired in 2015. Historic production, as I mentioned previously. Lots of infrastructure in place, access to roads, grid power and water. We're looking to get our plan of operations in place in the next couple of months, and then advance, take next steps to secure a large mining permit towards the end of this year, early next year. Slick Rock, acquired from UEC back in 2022. Historic production in the area from a couple of mines nearby. There's hopefully infrastructure in place here, shafts, portals, workings at site. We recently completed a 14,000-foot drill program in late 2024, which verified the resource that's there, the historic resource, and will allow us to potentially expand the resource and go forward and potentially incorporate that into our next PEA. And then finally, West Slope project, as I mentioned, this is something we acquired back in 2018 from Cotter Corporation. It consists of 9 leases. There's past production there, 1.3 million pounds of uranium, 6.5 million pounds of vanadium, lots of infrastructure, adits, underground stopes. You can see that the picture to the top right, that's our JD8 mine, there's the rail there, easy access to the adit, so fairly easy and quick for us to potentially move these back into production. And we may include this as part of the PEA as we go forward, because we do believe that there's significant economic benefit to having these mines up and running, especially if we have increased throughput capacity and increased production capacity. And finally, once again, reasons to invest in Anfield. We've got an advanced suite of assets. There are a few others with the capacity to begin production in the next 2 to 2.5 years. We've got the geographic advantage. We've got the largest installed base of reactors in the US, and yet very little domestic supply. So we believe all the pounds we can produce can be absorbed into this market. Third of all, peer valuation. The smallest of the producers or near producers trade at 5 to 40 times our market cap. We think that valuation gap should shrink, especially as we get exposure to the US market through NASDAQ. And then finally, the Buy American policy of the US government, tariffs being put in place, loosening of regulations, strategic mineral designation for uranium vanadium, a very pro-nuclear Secretary of Energy, and funds coming from the Department of Energy for the mill side of the business, and funds coming from the Department of Defense for the mine side of the business. I think all these things provide us with a really good basis from which we think we can grow real value in the US. And that's it. And so I've got a few questions here that I will answer. First question is, at what point will you be seeking to secure supply contracts, and what will it depend on? So that's a good question. I think from our perspective, I think we'll wait to see how the market moves. Obviously, the uranium price has been a little bit volatile recently. Typically, when you're securing a supply contract, it's usually to help fund the refurbishment of the mill or refurbishment of the mines. I think from our perspective, we're always happy to consider contracts, but it all depends on the price and the size of the contracts. We don't require that in order to move forward for the mill because we do have a built mill already. We just need to refurbish it, so the cost is significantly lower than building from kind of a greenfield perspective. But certainly, we're always open to the opportunity to seek out contracts. We're always in touch with utilities now. We haven't consummated any contracts, but we certainly have the option to do so. But we think that it makes more sense, starting small. And as uranium price continues to move up, then we may look to secure something. The next question: what are the biggest challenges in getting to production? Well, I guess the first thing is the funds to refurbish the mill. As I mentioned, the cost to build a mill is significantly higher than the cost to refurbish a mill. Our cost is probably sort of between $65 and $70 million for refurbishment. So securing those funds, it could potentially be a challenge, but we do have some significant partners like AEC, which is a $4 billion company, that can help us in that regard. But we also think that while we're refurbishing the mill, we may come across some other issues. The mill is 40 years old, and so we just need to make sure that all the parts work well together. But I think from a perspective of production, I think we're in a great position vis-a-vis anyone else who's looking to start from scratch. We have an existing facility. We've got a license, of which there are only 4 in the US. I think we're in a great position to move forward on the mill. Another question: are you accessing any government grants and incentives? That's a great question. We're in touch with both the Department of Defense for the mine side, looking for funding related to our mining activities, and we're in touch with the Department of Energy for the mill side, where they do provide long-term low interest rate loans. I'm sure you've seen some of the news. Some nuclear facilities have received multi-billion-dollar contracts and funding from the Department of Energy. We are not prioritized because we're not looking for that kind of money, but certainly we've been engaged with the Department of Energy, and hopefully we'll get some positive news in the coming months. But certainly, we've looked to access those funds, and they may change. It may accelerate it, under a new administration. So we're cautiously optimistic. The next question: is radioactivity a consideration for vanadium deposits? Well, I think radiation, because of vanadium assets, are actually, we've got both uranium and vanadium. The vanadium is going to be intermingled with the uranium, so the uranium itself will have radioactive risk. So because it's not a separate vanadium mine, you will still get some level of contamination or cross-contamination between the two minerals. So certainly there will be a consideration related to the vanadium mine because of its close proximity and cooperation with uranium. I don't see any other questions, so I think we can call it there. Thank you very much for your time. Thank you for taking the time to sit through the presentation, and feel free to reach out if you have any other questions.